Hi everyone, this video is about the outlook for property prices in Australia, and in particular, the dire warnings that property prices will fall by 20 to 25% in the next 12 to 24 months. Now, those doomsday type predictions about Australian property prices are really based upon a set of misunderstandings about the drivers of property prices and how property prices evolve through time. So here's a list of those misunderstandings. First of all, misunderstanding about historical dynamics, which is what we're going to talk about in detail in this video, but also a misunderstanding about property prices being driven by long-run interest rate expectations rather than the short-run interest rate expectations that the doomsayers of property price, the predictors that property price will go down by 20 to 25%, are focusing on. Then there's an issue about mortgage arithmetic. If interest rates double from where they are at the moment in Australia, then average mortgage payments will go up by 35%. Interest rates go up 100%, mortgage payments only go up by 35%. That seems to be misunderstood by many pundits. There's a misunderstanding about the level of mortgage distress that will result, and an exaggeration of mortgage distress that will result from increases in interest rates. And then there's a misunderstanding about how constrained the supply of new houses and new apartments are in Australia. But it's historical dynamics that we really want to focus on here. And we're going to do that using this graph. So this graph shows real house prices in Australia from the beginning of 1970 through to the end of 2021. That's 52 years from the beginning of 1970 to the end of 2021. And real, of course, means that inflation's been taken out. Now you can see straight away this pattern of property prices zooming up and then staying flat and zooming up and staying flat and zooming up, staying flat. And we want to understand that pattern and think about whether that's going to be repeated. Property prices have zoomed up. Are they now going to stay flat for a decade or so? We can see here that in the early 1970s, real property prices, remember inflation's been taken out here. This was a period of high inflation, but inflation's been taken out. Real property prices were rising at 10.6% for a number of years. And then they stayed flat. In fact, they declined on average per year through the late 1970s and through the 1980s. And then they zoomed up in the late 1980s. Then they were flat through the 1990s, zoomed up in the early years of this century, and then relatively a flat through to the beginning of the COVID-19 crisis, and then zoomed up through the COVID-19 crisis. So what we should expect on the basis of what we've seen in the past is that property prices will now not tumble by 20 to 25%, but be flat for a very extended period. Now, the reason we should expect that to happen is because there's a good economic reason that underlies that zooming up and then staying flat, zooming up and then staying flat. There's a good economic reason, and we see that same pattern in other countries that are similar to Australia. In Canada, it's remarkably similar pattern in housing prices. So what is it that causes that zooming up and then staying flat pattern in housing prices? We don't see that in stock prices. In stock prices, we see them going up and down and up and down, not up and flat and then up and flat, such as in residential property. In other asset markets, in the bond market, in the stock market, in commercial property, for instance, it's up and down, not up and flat. So what is it about property prices, the dynamics of property prices through time, the evolution of property prices through time that causes that? Well, what it is that when demand for properties go down, when the demand for houses goes down, such as it is at the moment, to get back to equilibrium of demand being equal to supply, it doesn't all have to happen through falls in prices. Because when demand goes down, prices start to fall, but then supply goes down. So people withdraw from the market. A couple who were thinking of selling their house in Melbourne and moving to Noosa put that off because house prices are now down. Somebody who was thinking of selling their house in Randwick and moving in Sydney and moving to Subiaco in Perth to work in the mining industry, now they put that off because they don't want to sell their house and experience a capital loss, or even to get a price that's lower than the high watermark price that they saw in the past. So there's a withdrawal of supply. Now that doesn't happen in other markets. In the stock market, which we're going to look at in a bit more detail in just a moment, that certainly doesn't happen. The supply of shares available for sale is fixed. So getting back to equilibrium is all about price. And in the property market, residential property market, it's not all about price. It's about a withdrawal of supply. Now on the flip side, it takes a long time for property prices to start going up, because when property prices do start to rise, a lot of supply comes back into the market and absorbs that increase in demand. So up and then flat, and we should expect that to be repeated in the future because there's a good economic reason for it. Now, let's have a look at that with some diagrams. And let's start off with the share market. Let's look at BHP shares. BHP's got about 5 billion shares, a bit more than that, but 5 billion will do for our discussion here. Let's imagine that 3 billion of them are available to be bought and sold. That portfolio managers are always thinking, I'll sell my shares if someone offers me enough, and I'll buy some more shares if the price goes down enough. And then there's 2 billion that are tightly held. But the float, the shares that are available for sale, let's imagine that that's 3 billion. And that doesn't change. Now, there's demand for BHP shares. So when the price of BHP shares goes down, then people demand more of those shares, other things equal. If the price goes up, then they don't want as many. And putting price and supply together here, we get the price in the market. Putting demand and supply together, we get the price in the market. Let's say that that's $40. Now, if the demand for BHP shares goes down for some reason, and at every price, the quantity that's demanded is lower because something's gone wrong with BHP. Maybe something's gone wrong with the whole of the market, and it's happening to all shares or just all mining shares, or it might be BHP specific. But demand's gone down. There's no adjustment of the float. It remains at $3 billion. So to get back to equilibrium, all of the adjustment needs to be in price, and prices need to fall a lot to get us back to equilibrium of supply equal to demand. Now you compare that to the housing market. Let's imagine that at any point in time, there's 100,000 houses available for sale in Australia. This is the volume of houses available for sale. And of course, of the 10 million housing units, houses and apartments in Australia, only a fraction of them are available for sale at any point in time. Most people are just living in their houses, or they own an investment property, and they're not thinking of selling. So the float as a proportion of the total stock of the asset is much smaller in the property market than it is, the residential property market, than it is in the share market. And in any case, let's imagine that this is what demand for houses looks like. And so we've got an equilibrium. Let's say the average house price is $1 million. That's a lot. It's a lot more than it is in some markets like Perth or Adelaide, and less than it is in Sydney and Melbourne, average price. But let's take that round figure. And then if demand falls, such as it is at the moment because of rising interest rates, then if the float didn't change, prices would have to fall a lot to get back to equilibrium. But the float does change. People withdraw from the market. The volume of houses that are available for sale does go down a lot when prices start to fall. And so now prices don't need to fall as much to get back to equilibrium of supply and demand. That's a characteristic of the property market. And it's why we don't see big falls. Even when there's big falls in demand, we don't see big falls in price because the falls in price induce a fall in the supply of houses available for sale. And of course, when we get to the end of these flat spots, and demand starts to rise, a lot of people come back into the market and soak up that demand or use up that demand before prices start to rise. So the effect that appears here, the reverse of it appears here. We get very long flat periods. Now that's what we should expect going forward. This is what I mean by people predicting 20 to 25% falls in property prices, not really understanding what the dynamics of property prices look like and what's driving it, and why the residential property market is different to other asset classes, particularly different from shares. Now, there's another thing that we should emphasize here, and it's the size of a 20 to 25% fall. So these are real house prices here. The largest real house price fall we've seen in the 52 years back to the beginning of 1970 is 12.7%. Now, it's true that in the Great Depression in the 1930s, and also in the Second World War and the immediate aftermath of the Second World War, there were very large falls in real property prices, but we're not talking about a Great Depression at the moment. We're certainly not talking about a world war. In normal circumstances of demand up or demand down, and prices up or prices down, then a 12.7% decrease in real prices is the most we've seen in the last 52 years. Now, what's being proposed by people who are saying that property prices will fall by 20 to 25% is twice the largest fall that we've seen. And we can see that in this diagram. So here's the nominal price growth. Ordinary nominal, meaning in name only or without inflation taken out price growth. And normal price growth is inflation plus real price growth. Those two things add up to nominal price growth. Now, if we have inflation of 7%, which is what we're looking at over the next year, then if we have a fall in house prices of 20%, that means a real fall of 27%. So nominal price growth minus 20% minus inflation minus 7 is real price growth. So a 20% fall over the next year in nominal inflation, no adjustment for inflation, is a 27% fall expected in real house prices. Now, that's absolutely unprecedented. That's more than twice what we've seen over the last 52 years. So it's really something quite extreme that's being proposed here. And we shouldn't expect that to happen. What we should expect to happen is that property prices will decline slightly. We should expect single-digit falls in property prices, a long period where there's no growth in property prices, no real growth in property prices, and perhaps even a slow decline in real property prices for 10 or more years. And then we'll be back to property prices, a period where property prices zoom up. But investors have got to be looking on the basis of understanding of the dynamics of property prices in Australia and in similar countries, that after property prices have zoomed up in COVID-19 and in previous periods, then we're going to have a long period of low growth. So investors need to put their property strategy in place based around low growth. Now, there's good property strategies that can be enacted in a period of low growth. Those are the kind of things that, amongst many other things, are discussed in my investments course, Finance Education for Investors. That's a 10-week course. That's coming up on the 3rd of October. So go to windlestone.com.au to find out more about the course and to enroll if you wish. And if you like this video, then please like it and subscribe. And I'll see you in the next one.